Good morning. Thank you for joining today's daily webinar. Today's topic is what is the 5-year rule for Mega Backdoor Roth? We're going to go into this topic at great length today. As always, please subscribe to our channel, like to this video to help get the word out to other solopreneurs like yourself. Go ahead and also type over your questions during the live webinar, and we'll go ahead and pause and answer those questions as they come in. The questions can be regarding today's topic, or it can be regarding self-directed IRAs, traditional 401ks, the rollover business financing 401k, and of course, any aspect of the solo 401k plan. In short, your questions don't have to be surrounding today's topic in particular. Okay, so again, today's topic is what is the 5-year rule for Mega Backdoor Roth? So, did you know that even if you successfully get money into a Roth account through the Mega Backdoor Roth strategy, you might not be able to touch it without taxes or penalties for years? That's right. The IRS has a little known rule that can make or break your Roth strategy. It's called the 5-year rule. And if you misunderstand it, you could accidentally end up with unexpected taxes and or penalties. Most people think once money is in a Roth, it's tax-free and penalty-free right away. But the truth is, it's a little more complicated. And if you are using advanced strategies like the Mega Backdoor Roth, you want to make sure you don't trip over this IRS rule. So in today's session, we are going to preview what the 5-year rule really means when it comes to the Mega Backdoor Roth. We'll cover why this rule exists, how it applies differently to contributions versus conversions, and what that means for your retirement withdrawals down the road. Looks like we have a question already here. Let's take a look at that question. Looks like it's regarding, I think I must have hit a button somewhere to have you send me the paperwork for setting up a bank account. But after review, I see I need brokerage accounts and I want to take a loan and invest the balance in equities. That's right. You're going to need a brokerage account instead. How can I get the link to have the paperwork done for me to open a brokerage account? Fidelity, the speed of the loan is paramount. There's one of the two primary brokerage firms you work with faster. So yeah, Fidelity and Schwab are the two most common brokerage firms our clients utilize to hold their funds for the self-directed solo 401k that we offer. And typically it's quicker with Fidelity. So go ahead and what I'll do is I'll flag your account here. Give me a moment here. And we'll flag it so that we clarify that you want to use a brokerage account instead of a bank account to hold the solo 401k funds. Give me a moment here. Go ahead and type over any questions you have during the daily webinar while I take care of this here. And then we'll pick up on today's topic as well, which is what is the 5-year rule for Mega Backdoor Roth. Give me a moment here. Okay, so we've got a question here from Z. If I move my solo 401k from IRA Financial that is currently and Fidelity, all non-prototype accounts, do I have to open new non-prototype accounts with Fidelity? Great question. And the answer is no, you will not. So if you're looking to move your existing solo 401k from one of our competitors, such as IRA Financial Group, that's known as a restatement. And since you already have the non-prototype brokerage accounts at Fidelity open for that particular solo 401k, you're going to be able to keep the same plan name, same EIN number, and same brokerage accounts. When you complete our online application to restate that existing plan to our plan so that you fall under our plan and therefore our plan support, on the online application, we're going to ask for the original effective date of that existing solo 401k plan, which you can obtain from reviewing that existing plan's document known as the adoption agreement. There's a section titled original plan effective date. Make sure you list that date on that online application, as we will need to populate that date along with today's date, the restatement date, on the new plan documents, including the adoption agreement. Good question. Got another question here from Shirley. Our company made employer Roth contributions to the 3 employees, myself, my husband, and our son. Contribution was made on December 31st, 2024. I just read now that our company need to issue 1099-R to the employee for the contribution to employee Roth. Can your company help with the 1099-R? Your company has set up the plan solo 401k for us. Go ahead and submit a support ticket because that form 1099-R it's actually past due. That was required to be provided to the IRS by March 31st of this year. And we issue Form 1099-Rs for clients who timely request it. You are now requesting it after the fact. So go ahead and submit a support ticket so that we can review it and we can figure out how to help you report that. But you are correct. Anytime you make an employer Roth solo 401k contribution stemming from Secure Act 2.0, even though it's made as an employer Roth solo 401k contribution, don't confuse the employee Roth solo 401k contribution. Here we're talking about employer Roth solo 401k contributions. Even though that's made as an employer Roth solo 401k contribution and it goes directly into the Roth solo 401k bucket, and the business gets a tax deduction for that contribution, it's treated as a taxable in-plan conversion on your personal tax return. So it's kind of quirky. So the business gets a deduction, but then you're going to have to pay taxes on that amount that was contributed as an employer Roth solo 401k contribution. So if you made, let's say, a $10,000 employer Roth solo 401k contribution, you're going to have to pay taxes on $10,000, and that's got to be paid on your personal tax return. And a Form 1099-R has to be issued to report that as a distribution. So as a taxable conversion, essentially. So it won't be subject to a 10% penalty, but it will be subject to federal taxes and possibly state taxes. Let me provide a link to our support page so that you can submit a support ticket regarding your particular situation. And if all the participants in the plan made employer Roth solo 401k contributions, then a separate Form 1099-R has to be issued for each participant. Give me a moment here. Share the support page on our website so you can submit a support ticket. Okay, I just shared that support ticket page with you. In the meantime, give me a moment here. Again, go ahead and type over your questions during today's daily webinar, and we'll pause and answer those questions as they come in. Looks like we had another question here from 2 Cent Harry. Can separate company I own, not the one supporting the 401k, have employees? No, it cannot. Great question. So under the IRS control group regulations and also the affiliated service group regulations, which can get pretty complicated in a real quickly, let me share a link to those control group regulations. But essentially, those control group regulations require that if you own multiple businesses and you are the owner of those businesses, and any of those businesses that you own employ any non-owner full-time W-2 common law employees who work 1,000 hours or more in your business, and you're looking to open a solo 401k plan, if any of those businesses employ a full-time W-2 employee who is a common law employee, again, they're not an owner in the business, but they are a common law employee and they work 1,000 hours or more, then you cannot open a solo 401k plan, even for the other business where it's just you. That's known as the control group regulations. So you would not qualify to open a solo 401k plan. Let me share some information regarding the control group regulations, because again, those rules can get really complicated and there are percentage tests that apply. There's the link to that control group page on our website. And if you scroll down on that page, there's a chapter that's about 80 pages that the IRS has published on this topic. Let me share that link as well, which you can also find on that page I just shared with you. There's that link. Okay, so let's get started with today's topic again, which is what is the 5-year rule for the Mega Backdoor Roth? We're going to go over that topic in great detail today. So number one, the Mega Backdoor Roth solo 401k strategy, that's where someone who wants to utilize a solo 401k to supercharge their Roth solo 401k savings indirectly, they utilize the Mega Backdoor Roth solo 401k strategy because it allows you to get a lot more money into your Roth solo 401k than the typical amount that can be made as an employee contribution or as an employer contribution. For example, you can contribute all the way up to the overall limit for the year as a voluntary after-tax solo 401k contribution and then turn around and convert it to the Roth solo 401k or the Roth IRA. And for tax year 2025, the overall contribution limit is $70,000. So depending on how much self-employment income you have, obviously you have to have enough net self-employment income in order to contribute the full overall limit of $70,000 as a voluntary after-tax solo 401k contribution for tax year 2025, and then convert that to the Roth solo 401k or the Roth IRA, and that's what the Mega Backdoor Roth solo 401k strategy is. So the 5-year rule when it comes to the Mega Backdoor Roth solo 401k. So again, when you convert voluntary after-tax solo 401k funds to the Roth solo 401k, now it'll result in having funds in the Roth solo 401k, and therefore the 5-year rule automatically applies indirectly to the Mega Backdoor Roth strategy. But once you convert those funds from the voluntary after-tax solo 401k to the Roth Solo 401k, you've got a 5-year holding period that applies. The 5-year rule applies to Roth Solo 401k plans and even Roth IRAs. In the context of a Roth Solo 401k, the 5-year rule deals with when you can distribute funds from the Roth Solo 401k without having to pay federal taxes, as well as a 10% early distribution penalty. So there's what's referred to as a qualified Roth Solo 401k distribution, and then there's a non-qualified Roth Solo 401k distribution. And we're going to give some examples in other slides here. But for it to qualify as a qualified distribution from a Roth Solo 401k plan, that means you want to take money out of the out of the Roth Solo 401k plan, and you want to use those funds for personal use. We're not talking about when you convert the voluntary after-tax Solo 401k contribution to the Roth Solo 401k. That's not a taxable event. That's not considered a distribution. That's considered a conversion. And you want to convert those voluntary after-tax Solo 401k contributions right away so that there are no gains. Because if there are gains, the contributions will not be taxable, but the gains that get converted to the Roth Solo 401k or the Roth IRA are taxable. But once those voluntary after-tax Solo 401k funds have been converted to the Roth Solo 401k, for example, now the 5-year rule applies to that Roth Solo 401k. So if you want to distribute funds from that Roth Solo 401k, it's got to meet the qualified distribution rules. And there are 2 rules that make up the qualified Roth Solo 401k distribution rule. One is you have to be age 59 and a half or older. And the second one is you have to have had that Roth Solo 401k for at least 5 years. So if you meet both of those rules, that is your age 59 and a half or older, and have had that Roth Solo 401k for at least 5 years, then you can distribute funds out of that Roth Solo 401k plan tax and penalty free. And that, of course, would apply to the basis as well as the earnings. Now, a non-qualified distribution is when you distribute funds from the Roth Solo 401k and you have not had that plan for at least 5 years, and you are under age 59 and a half. When you distribute funds from a Roth Solo 401k plan before those 2 rules have been satisfied, then you're going to have to pay taxes on all those earnings, as well as a 10% penalty on the entire balance. But of course, the basis, if they're made up of voluntary after-tax Solo 401k funds that were converted, those would not be subject to taxes, but they would be subject to that 10% penalty. What is more, you can't even distribute funds from that Roth Solo 401k until you're age 59 and a half or older, or if you're no longer self-employed. So the rules can get really complicated pretty quickly. So in short, anytime you decide that you want to take a distribution from your Roth Solo 401k plan, it's going to be best to check with your Solo 401k provider. Here at my Solo 401k Financial, as a Solo 401k provider, we're well versed on the regulations. So we always tell our clients that anytime you take a distribution from a Roth Solo 401k, to make sure to run those regulations by us to determine A, whether you even qualify to make a distribution, and B, that you understand what those tax implications are, if any. So as far as why that 5-year rule exists, it probably exists. I mean, I'm not sure why Congress created that rule, but I can suspect it probably exists because at the end of the day, retirement funds, whether Roth or pre-tax funds, they are meant to be used to save for retirement. they're not meant to be used prior to retirement. So it's a way of accumulating funds for retirement, especially since the Social Security fund's probably going to be gone here in the next 5-10 years. I mean, who knows? But I suspect that Congress decided to put in this 5-year rule in place to help keep individuals from distributing funds out of their solo 401k, whether pre-tax or Roth solo 401k funds. Okay, then we talked about, well, we're going to talk about how it applies to contributions, that is the 5-year rule, versus conversions, and what it means for retirement withdrawals. So we just discussed the 5-year rule, and as you can see, it's not as scary as it sounds. We talked about how there's the 5-year rule is made up of a qualified distribution versus a non-qualified distribution. We talked about how for it to qualify to be deemed a qualified distribution is you have to have had the Roth solo 401k for at least 5 years and be age 59 and a half. We talked about how it's a non-qualified distribution if you distribute funds before you're age 59 and a half and have not had that Roth solo 401k for 5 years. So and we talked about the 2 different 5-year rules you need to know. And we talked about how they apply specifically to the Mega Backdoor Roth. So let's recap how it applies to the Mega Backdoor Roth. So when you make contributions to the voluntary after-tax solo 401k plan, then those go into the voluntary after-tax solo 401k bucket. You then convert those to the Roth solo 401k. So when you convert the voluntary after-tax solo 401k funds to the Roth solo 401k, or the Roth IRA for that matter, that's not considered a distribution. That's considered a conversion. A distribution is when you take receipt of the money from your retirement account and then you use those funds for personal use. That's a distribution. We talked about when you can touch the Mega Backdoor Roth funds. So as far as when you can touch the Mega Backdoor Roth solo 401k funds, we talked about how those get converted to the Roth solo 401k, and you got to meet that 5-year rule. Now, when you contribute those funds to the voluntary after-tax solo 401k bucket, those go in as an after-tax contribution. So don't confuse the voluntary after-tax solo 401k contributions with Roth solo 401k contributions. Those are different source of funds and different regulations. So when you make that voluntary after-tax solo 401k contribution, the whole point of making that voluntary after-tax solo 401k contribution, as I mentioned earlier, is to indirectly get more Roth solo 401k money into your retirement account. That is the solo 401k plan. So once you make that voluntary after-tax solo 401k contribution, you want to convert that right away to the Roth solo 401k or the Roth IRA. And we will need to make sure you understand how that process works. So if you're a client of my solo 401k financial, we'll shepherd you through that process, including how to move the funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket or to a Roth IRA. And there's no 10% penalty that applies when you process a conversion of the voluntary after-tax solo 401k to the Roth solo 401k or the Roth IRA. Okay, so again, please subscribe to our channel for more videos like this. Please also like today's video to help get the word out to other solopreneurs like yourself. And go ahead and shoot over your questions, and we'll go over those questions as they come in. We're going to go over some more information here. Let's take a look at some questions here, and then we'll take a look at the slide next, which is, can I transfer out Roth solo 401k funds before 5 years? We get this question quite a bit. Okay, let's see here. See what other questions we have. Um, where are we? So we've got a question here from him. Uh, uh, in the Mega Backdoor Roth discussion, but as a follow-up to my question about opening a Fidelity account, can you let me know what you did for me? I'm not sure I understand what you did. Did you ask someone at your organization to start that paperwork, or do I need to do something? What are the next steps for me? I just want to receive documents. Sorry again. So yes, we're going to be sending you information for opening up the brokerage accounts at Fidelity for the solo 401k plan. We'll get those out to you today. And then after that, once Fidelity opens those brokerage accounts, then it'll be time to either transfer any IRA or former employer plan to the solo 401k, or you can make contributions. And then once those funds are in the plan, you can use those to start investing as well as processing a loan, a 401k participant loan, and we'll prepare those loan documents as part of the process. Okay, let's see here. Got a question here from Stephen. If you do a mega backdoor at age 58 of 70,000 into Roth IRA, does that contribution amount have to stay 5 years, even though the Roth IRA withdrawal age is 59 and a half? Good question. So the Mega Backdoor Roth Solo 401k strategy. So there's a difference between the Mega Backdoor Roth Solo 401k and the Backdoor Roth IRA. The Mega Backdoor Roth Solo 401k is when you make a voluntary after-tax solo 401k contribution to the solo 401k, and then you can convert those funds to the Roth IRA or the Roth Solo 401k. The backdoor Roth IRA is when you make a non-deductible IRA contribution, which is $7,000 for tax year 2025, and then immediately convert it to the Roth IRA. So if you utilize the Mega Backdoor Roth Solo 401k and you make a voluntary after-tax solo 401k contribution of $70,000 for tax year 2025, assuming you had enough net self-employment income to justify that contribution, yes, you can convert that $70,000 voluntary after-tax solo 401k contribution to the Roth IRA. If you're opening up a Roth IRA for the first time, then you're going to have that 5-year rule start for the first time under that Roth IRA under that Roth IRA. On the other hand, if you've had a Roth IRA for, let's say, 5 years already and you're age 59 and a half, and you convert those voluntary after-tax solo 401k funds to that Roth IRA, then the Roth IRA distribution regulations will apply to that Roth IRA. So the Roth solo 401k or the solo 401k 5-year rule would not apply, because now those voluntary after-tax solo 401k funds have been converted to that Roth IRA. So the Roth IRA 5-year rule would apply in that instance. Okay, good questions. Go ahead and keep typing over your questions during today's daily webinar, which is, what is the 5-year rule for Mega Backdoor Roth? So we've been talking about that topic at great length. Let's look at this slide here, which we get this question quite often, which is, can I transfer out Roth Solo 401k funds before 5 years? So to clarify, this here means that A, you made a Roth Solo 401k contribution directly to the Roth Solo 401k, or B, you made a voluntary after-tax solo 401k contribution that you then converted to the Roth Solo 401k. In other words, you did not convert that voluntary after-tax solo 401k to the Roth IRA, but instead you converted it to the Roth Solo 401k. So The question again is, can I transfer out Roth Solo 401k funds before 5 years? So in other words, before the 5-year Roth Solo 401k rule has been satisfied. So the answer is yes, you can if you are age 59 and a half or older, or no longer self-employed. So unlike the voluntary after-tax solo 401k as part of the Mega Backdoor Roth solo 401k, where the voluntary after-tax solo 401k contribution can be converted to the Roth solo 401k or the Roth IRA, Roth solo 401k contributions have a different rule. You have to meet a triggering event in order to get those funds out of the Roth solo 401k plan, which are these two rules listed here. That is, you have to be age 59 and a half or older, or no longer self-employed. Now, regarding that second bullet, no longer self-employed, once you stop being self-employed, you can no longer continue with that solo 401k plan anyways. You're going to have to close the solo 401k plan down and transfer it to the Roth IRA. So that's a triggering event, no longer being self-employed. Now let's keep reading this slide here. However, if the Roth Solo 401k funds have not satisfied the 5-year holding period, the earnings on that Roth Solo 401k cannot be distributed from the Roth IRA without paying taxes on the earnings until the Roth Solo 401k funds have met the 5-year holding period in the Roth IRA. So that means that Roth Solo 401k 5-year holding period essentially gets picked up and moved over to the Roth IRA. So as a result, you will need to separately track the Roth Solo 401k earnings and the Roth IRA if you plan to take distributions from the Roth IRA before the 5-year clock has been satisfied. Because keep in mind that the Roth IRA regulations have their own 5-year clock and they have order rules. So with the Roth IRA, you can distribute funds that you contribute to the Roth IRA on an annual basis. Those can be distributed anytime, tax and penalty free, even if you're under age 59 and a half. That's part of the Roth IRA distribution rule. The second, so once you exhaust all your distributions from the Roth IRA stemming from contributions, from annual contributions that you made to the Roth IRA, the next set of funds that can be distributed from a Roth IRA are any funds converted to that Roth IRA. And if you're looking to distribute funds from the Roth IRA that were converted from the pre-tax solo 401k or transfer from the Roth solo 401k bucket to the Roth IRA, then you've got this 5-year rule that I just discussed here on this slide that will apply to those funds distributed from the Roth IRA. Now, keep in mind that if you've already met the 5-year rule under that Roth IRA, that is, you've had that Roth IRA for 5 years, and you're age 59 and a half or older, then all the funds that you distribute from the Roth IRA will be tax and penalty free, including the funds that you transfer from the Roth Solo 401k to the Roth IRA. So this rule I just talked about here is if you have not had that Roth IRA for 5 years and you are not age 59 and a half or older. Okay, let's see here. Again, go ahead and type over any questions you have during today's daily webinar, and we'll stop and answer those questions as they come in. Let's take a look at some more slides here. The start date of that 5-year Roth Solo 401k holding period. So the 5-year Roth Solo 401k holding period starts on January 1st of the year for which the Roth Solo 401k contribution was made for, or when funds were first converted from the voluntary after-tax Solo 401k to the Roth Solo 401k. So let's take a look at some examples on that. Example 1. Let's say Janice is self-employed and her LLC is taxed as an S corporation. Janice has had a solo 401k since tax year 2019, but has never made any Roth solo 401k contributions to the plan. She makes her first Roth solo 401k contribution on March 10th of 2025, and she treats the contribution as being made for tax year 2024, since she is making the contribution before the due date of March 15 of her self-employed business tax return. So as a result, her Roth Solo 401k 5-year holding period started on January 1st of 2024. So let's translate this. So when you're self-employed, you can be self-employed as a sole proprietorship, as a partnership, or as an S corp. It can even be an LLC taxed as an S corporation. When your LLC is taxed as an S corporation, you have until the following year to make both employee and employer solo 401k contributions. So Janice has had the solo 401k since 2019, but she decided to wait to make her tax year 2024 contribution here in 2025, which is allowed under the regulations. So since she made her Roth solo 401k contribution on March 10th, because her S corporation tax return was due March 15 of 2025 for tax year 2024, she made that contribution on March 10th, 5 days prior to the S corporation tax return due date for 2024. That contribution counts as a 2024 year contribution. As a result, her 5-year clock is going to start on January 1st of 2024, which is more favorable for her than having it start on January 1st of 2025. So she already has a 1-year start on that 5-year clock for being able to make Roth solo 401k distributions under that 5-year clock. Let's take a look at example 2. So same as above. So Janice has had her solo 401k plan since 2019. She decides to make a contribution to the Roth Solo 401k for tax year 2025. Let's say she's going to make that Roth Solo 401k contribution on October 5th of 2025, based on her tax year 2025 W-2 wages. Her 5-year clock is going to start on January 1st of 2025, not January 1st of 2024, because she's making the contribution based on her W-2 wages from tax year 2025, and she's making it as a 2025 contribution. So the prior slide is an example of when the 5-year clock would have started January 1st of 2024, because she was making a contribution for tax year 2024 based on her W-2 wages from 2024, and she made that contribution prior to her S corporation's 2024 tax year tax return due date of March 15, 2025. She made the 2024 contribution on March 10th for 2024. So therefore, the 5-year clock started 1 year earlier. That's January 1st of 2024. Let's take a look at some more slides here. Let's take a look at example 3. Here we've got James. Let's say James is self-employed and his own LLC is taxed as an S corporation. So his self-employed business is an LLC taxed as an S corporation. James has had the solo 401k since 2024, but has never made a Roth solo 401k contribution. And he has never processed any Mega Backdoor Roth conversions either to the Roth Solo 401k plan. So James performs his first Mega Backdoor Roth Solo 401k conversion on July 22nd of 2025. As a result, his Roth Solo 401k 5-year clock holding period will start on January 1st of 2025. That's because conversions are always reported as of the year that the funds are converted from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket, or if you're processing the conversion of pre-tax solo 401k funds to the Roth solo 401k bucket, conversions are always reported in the year that the conversion is processed. That's different from the contribution rules. So don't confuse these examples here, example 1 and 2, because those deal with making contributions. Those don't deal with processing a conversion of the Mega Backdoor Roth Solo 401k or converting pre-tax Solo 401k funds to the Roth Solo 401k. Those are always treated as a conversion in the year that the funds are actually moved from the pre-tax Solo 401k bucket or the voluntary after-tax Solo 401k bucket to the Roth Solo 401k bucket. All right, those are the slides we wanted to go over with you today regarding what is the 5-year rule for making Mega Backdoor Roth. Looks like we've got another question here. I actually went over, well, here we go. We've got a question here from Zach. The moral of these examples is that when you set up your Roth Solo 401k, you should always make at least contribution of 100 to your Roth to start the 5-year rule. Yeah, that's a good comment. You're exactly right. As soon as you first get funds into that Roth Solo 401k bucket, the 5-year clock starts. So, for example, if you open a Solo 401k plan here in 2025, you can make a small Roth Solo 401k contribution of, like you stated there, $100, and that'll start the 5-year clock as of tax year 2025. Also, let's say you open the Solo 401k plan for you opened it. Well, yeah, I think we went over that example already. I was going to say, let's say you opened the Solo 401k plan last year in 2024, and you're now making a contribution for tax year 2025 here in 2024, and you make a Roth Solo 401k contribution. That Roth Solo 401k clock would actually start January 1st of 2024, not January 1st of 2025. So those are things to keep in mind. I don't see any other questions right now. If you have any more questions, go ahead and type them over because we're just about done. We'll be going live again here in a few hours. So if you did not get a chance to ask your questions now, you can ask them at that time. While we wait for any other questions here, let's talk about a couple other items. Let's talk about how just one 5-year holding period applies. So if we're talking about Roth IRAs, this one 5-year holding period applies to Roth IRAs. So let's say you opened up a Roth IRA when they first became available back in 1998. Let's say you made a Roth IRA contribution in 1998. And let's say you ended up closing that Roth IRA that you opened up in 1998. Let's say you closed that Roth IRA in tax year 2010. And then you turned around and you opened up another Roth IRA. Let's say you opened a Roth IRA today. Well, great news. That 5-year period of that Roth IRA that you opened up in 1998, even though that Roth IRA is already closed, which you would, let's say you close it in 2010, you will have already met that 5-year period under the Roth IRA, because once you meet that Roth IRA and any Roth IRA that you've ever had, that Roth IRA clock continues. So now, if you open up a Roth IRA here in 2025, you're going to fall under that 1998 Roth IRA clock. So that means that if you have funds in a Roth IRA, you're going to be able to distribute those funds from that Roth IRA tax and penalty free if you've had that Roth IRA for 5 years and you're over age 59 and a half. Well, again, you already met that 5 year holding period back in 1998. And if you're over 59 and a half, anytime between 1998 and now, you will have already also met that age 59 and a half holding period as well. So you'll be able to make Roth IRA distributions tax and penalty free. So that's something to understand regarding how just one 5 year Roth IRA period applies. Now, in the context of a Roth solo 401k plan, that same 5 year rule does not apply. In other words, each Roth solo 401k plan has its own 5 year period. Same thing with, let's say you have a Roth 401k with your daytime employer. The 5 year clock of that daytime employer, the Roth 401k, cannot be applied to the Roth solo 401k plan. So, in short, every 401k has its own separate 5 year holding period regulation. It's not as advantageous as the one 5 year holding period that applies to Roth IRAs. Okay, now some other methods of starting that 5 year holding period in that Roth solo 401k is by transferring a former employer Roth solo 401k plan to the Roth solo 401k. When you transfer a former employer Roth solo 401k to the Roth solo 401k, the 5 year period would start now inside that Roth solo 401k. However, and I don't want to get too much in the weeds here. Let's say you want to distribute those former employer Roth 401k funds that you transferred to the Roth solo 401k. You're going to be able to utilize that former employer Roth 401k 5 year period inside this Roth solo 401k. But again, that's a whole different topic. I don't want to confuse you too much because all this stuff gets really confusing under all these different scenarios. Another way to start the Roth solo 401k clock right away is by processing a conversion of pre-tax solo 401k funds to the Roth solo 401k, or by processing a voluntary after-tax solo 401k conversion to the Roth solo 401k as part of the Mega Backdoor Roth solo 401k strategy. All right, looks like we got one more question here and then we'll be done for today. Do I have to roll over my past employer 401k into my solo 401k? No, you are not required to transfer any IRAs or former employer plans to the solo 401k, even though the solo 401k is oftentimes used to consolidate other retirement accounts. And if you do transfer an IRA or a former employer plan to the solo 401k, then that's not going to count towards your annual contribution limit. Those are separate regulations. Does it count toward the 250,000 threshold for reporting to the IRS? Yes, when you transfer IRAs or former employer plans to the solo 401k, now it'll be considered a solo 401k. So those funds will no longer be considered former employer or IRA funds, and therefore the solo 401k rules will apply, including the threshold of having to file an annual return, information return for the Form 5500 Easy once the fair market value of that entire plan, including all participants' funds, whether pre-tax, Roth, and voluntary after-tax added together, exceed $250,000 in value. Once that threshold is met, you have to file an annual Form 5500 Easy return, which is it's an informational return. It's not a tax return, but rather an informational return. And here in my solo 401k financial, we'll file that for our clients who timely request that, and we don't charge additional fees for clients who timely request assistance in filing that annual Form 5500 Easy, just like the Form 1099-R. All right, great. Thank you for participating today. Please like today's video, subscribe to our channel to help get the word to others, solopreneurs like yourself. We'll be live again in a few hours. Until next time, have a great rest of the day.